You're listening to the Practical Tax Podcast with tax attorney Steve Moskowitz. The Practical Tax Podcast is brought to you by Moskowitz LLP, a tax law firm.
Welcome to our podcast, and today we're going to be talking about business entities, corporations, certain types of corporations like S corporations, partnerships, LLCs, and I'd like to introduce my friend and colleague, the manager of our tax department at Moskowitz LLP, Cliff Capdeville. Cliff is both a tax attorney with many years' experience and also an accountant. Cliff, tell us about these different business entities.
Sure, Steve. So one of the first questions that we need to answer for any new client and oftentimes for returning clients is, what's the best way to structure your business? Is that going to be as a sole proprietorship, a C Corp, an S Corp, or a partnership structure like an LLC or limited partnership? And there are different answers depending on the type of business. So the simplest form of structure is what's called a sole proprietorship. And that's when you're essentially doing business in your own name or as a DBA. It's the easiest business structure to set up, but it's not a separate legal entity. And for that reason, we usually don't recommend it. As you know, Steve, a lot of what we do is asset protection. We want to protect the business owner's assets. And the sole proprietorship does not separate personal assets from the business assets. And as a result, we usually don't recommend the S corporation, the sole proprietorship. Instead, we usually recommend an S corporation or an LLC,
Cliff,
depending on the type of
somebody
business.
has a sole proprietorship and something goes wrong in the business, they could sue and take away the person's personal assets?
That's the problem with it, Steve. And I know you've seen this in your practice. It comes up all the time. And we've also seen businesses survive and owners keep substantial assets if they've properly separated their assets from the business assets.
You know, you told us about different forms of assets, and corporations is one of them, but sometimes a business owner might say, but Cliff, you know, if I form a corporation, it's great for asset protection, which I'll ask you to explain to us. But people say, well, wait a minute. I don't want to be paying taxes twice, first the corporate taxes and then the personal taxes. How do we handle that?
Yeah, so today we're going to talk about S corporations, and S corporations are considered pass-through entities for tax purposes. So what does that mean? That means that there's no tax typically at the corporate level. The tax attributes pass through to the individual owners. So you're only paying tax at one level with an S corporation or an LLC, just like you would with a sole proprietorship. But the huge advantage of the pass-through entity is that asset protection that we mentioned.
So does that mean that if the business gets in trouble, that the assets of the owner are safe?
If they run the business properly and they mind their P's and Q's, they can potentially protect their personal assets from the assets of the business.
And Cliff, what happens if the business makes a loss?
Well, in that case, in many instances, the business can pass through those losses to the individual owner, who can deduct those losses against other income.
So if the owner made a loss and his or her spouse had a profitable business or wages, you could offset one against the other?
That's right. And we often will use that strategy to save clients a lot of money.
And Cliff, tell us this. Suppose we're looking at two neighbors, John and Mary, and they make identical amounts. And Mary's in business and she's made a profit of 100. And her next door neighbor, John, gets wages of 100. If Mary went ahead and did an S Corp, could she go ahead and only pay a lesser amount, like 80% of her income? How would that work?
Yeah, we're going to talk about the qualified business income deduction in just a minute. That is one of the advantages of the S corporation and the other pass-through entities, is that with the Tax Cut and Jobs Act, Congress attempted to level the playing field tax-wise with C corporations. So as you remember, C corporations are now taxed at a 21% tax rate generally for federal taxes. And in an attempt to give a tax break to S corps and LLCs that would mimic that tax structure, the Congress introduced what's called the qualified business income deduction. And that's something that has been very important in terms of planning in the last few years, and it does provide a substantial deduction for many businesses.
So Cliff, taking that forward, does that mean if Mary walked in the door and Mary was a sole proprietor and she made a profit of 100, does that mean if you turned her into an S corp, she'd only have to pay taxes on 80% of her income instead of 100%, just by changing her business entity from a sole proprietor to an S corp?
In many cases, that's correct, Steve. So the net income of an S corp or other pass-through entity like an LLC is often entitled to that qualified business income deduction, which can be as much as 20% off the top, which is a huge advantage.
I think anybody in their right mind, given a choice between paying tax on 100% of their income or 80% of the income, I'm going to bet that they're going to go with the 80%.
Well, you would think so.
I would think so. So this is great. How do you become an S corp?
So that's a filing that we do a combination with the state and the federal government. So with the state, we set up the corporation, and then we notify the IRS that you're choosing to be treated as an S corporation, as a pass-through entity for tax purposes.
So we know that when somebody incorporates, if they don't do anything, they start off as a C corp where they pay the double taxation. Suppose Mary walks into the door and says, "Oh no, I started this company 10 years ago. It's been a C corp. I don't want to go out of business. What can I do?"
Well, you can make an election to become an S corp at any time. We're going to talk about the planning around that in a little bit, but in general, that's allowed. So even if you've been operating as a C corp for many years, you can convert to an S corp and take advantage of some of these benefits of the pass-through entities.
And Cliff, could you update us? Because I know in past years, the ability to be an S corp was so much more limited than it is now. Can you tell us now what we do to be an S corp, all the people that are included?
Yeah, so now you can have up to 100 shareholders, and that's a huge advantage, Steve. So one of the issues that prevented many entities from choosing the S corp form was a restriction on the number of shareholders, for example, and that's been expanded over the years. There are still restrictions, and you have to be mindful of those. And you really, if you run afoul of the S corp rules, the IRS can treat you as a C corp. And what does that mean? That means double taxation. Taxation at the corporate level, and then taxation again as you distribute money at the individual level as dividends. So that's one thing that we're very careful about when we're talking to clients, is make sure that they understand the rules for an S corp and make sure that they follow those.
Excellent. And tell us, Cliff, with an S corp, what are some of the advantages of having an S corp over some other form of business?
Sure. So let me tell you how we analyze a client's business as they come in the door, what we look for, and what to be cautious about when that client is trying to decide on the choice of entity. So one thing we want to be careful about is separating those personal and business expenses. And this can cause real headache, not only for tax purposes when you're trying to prepare tax returns, separating the business from the individual expenses, but also in terms of liability, because an Escort that is not mindful of those corporate formalities can run into trouble if they ever have a problem with the vendor or any kind of judgment or lawsuit. That can be a real problem. Another issue that we run into all the time, and the IRS is now carefully scrutinizing this, is owner compensation. So an advantage of the S Corp is that the net income of the business after wages is not subject to self-employment tax. Some business owners make the mistake then of not paying themselves any compensation. And that is something that the IRS is looking at carefully now. So we're going to meet with the client and explain the reasonable compensation issues, make sure that the business owners of an S corporation are paying themselves appropriate salaries. And to your question about conversion, we also look at what's called the built-in gains tax. And this is a corporate level tax that can apply when a C corporation has assets with built-in capital gains, and on conversion, the IRS could be looking for a check to pay those taxes as if those assets had been disposed of. So we have to be careful there. Other things we look at, we mentioned the qualified business income deduction. We're going to do careful planning there to make sure that the client is taking full advantage of that.
Cliff, I had a question on that one. With doing that, that's the one where you get to pay 80% of your profit instead of 100%, which is really good. Explain to us how it's important to plan with the wages to maximize our deduction on that one.
Sure. So what you want to do, you want to make sure that the net income of the business is below the threshold to qualify for the qualified business income deduction. That's going to depend on a number of factors, but we're going to help you plan around that, make sure that we claim enough expenses so that your business qualifies. Also, we want to make sure that you are paying yourself reasonable compensation for a number of reasons, but the IRS is looking carefully at that issue. We can use that compensation to potentially reduce the net income of the business. And also importantly, Steve, we can use that owner compensation as a basis for a retirement plan contribution. And this is hugely helpful for many clients. We can dramatically reduce their income if they use an S corporation, paying themselves a salary, and then turning around and using that salary to fund a retirement plan. It's a very powerful tax savings tool.
So Cliff, I think what I'm hearing here is this. Suppose the owner of the S Corp has made a profit of $1 million, and the owner is going to take $1 million out of the S Corp into their account personally. But you would help determining of the $1 million that's coming out of the corporation, how much should be wages and how much should be distribution, because by figuring the right amount of wages, it sounds like you're getting a double benefit here. One, you're qualifying to pay tax on only 80% of the profit instead of the other. And two, you're maximizing your pension deduction, saving still more in taxes. Is that right?
That's absolutely correct, Steve. So these are very, very powerful planning tools. And we do this every single day. And we are saving our clients many hundreds of thousands of dollars in some cases in taxes.
Now, Cliff, sometimes people will say, oh, I can't be all those corporate formalities. Oh, I'm just a simple business person. You can go ahead and do all those formalities for the client. And how does that work?
Yeah, it's much easier than it sometimes appears. People are often intimidated by the idea of forming a corporation. It can be done very quickly. You do have to mind those formalities and make sure that you're keeping up to date with the state's reporting requirements. But it's a tiny expense relative to the tremendous savings that's possible.
So basically, Cliff, would it be fair to say that if a client came to you one day a year, that you could do all the corporate formalities and they'd have all the benefits of the asset protection and all these tax savings?
Absolutely. It typically can be done over the phone or on Zoom. It's pretty simple relative to the tax savings, and that's why we recommend it so often.
So maybe just a couple of few hours with you on the phone or the Zoom, and you get all these benefits. That sure seems worthwhile to me.
It's absolutely worthwhile. A couple other things I want to talk about in our last few minutes, Steve. One is we get calls every day from clients, business owners who now have employees scattered throughout the states. They're doing business in many states, and maybe up until the pandemic 2 years ago, they had all of their employees in one office in California, and now they're scattered all over the world. How does that change the reporting requirements? And this is, it's a challenge. But it's certainly something that's not insurmountable. We work with clients to make sure that they're up to date with all the reporting and tax requirements on all of their U.S. filings, no matter where they're employees and no matter where they're doing business. The other thing I want to talk about is probably one of the more confusing news items that we've seen this year is what's called the SALT tax workaround, the state and local tax workaround. This is in reaction to the 2017 Tax Cut and Jobs Act, where the Trump administration pushed for dramatic limitation in the ability of taxpayers to deduct their state and local taxes, limited to $10,000. In reaction to that, many governors and legislatures throughout the country in high tax jurisdictions have been attempting to work around that issue so that taxpayers are able to deduct those state and local taxes again. And in California, there is what's called AB 150, AB 113. Those are two laws which now allow the deduction on the tax return for those state and local taxes. The way that it works is a little complicated. Essentially, business owners of Escorps, other pass-through entities, can now pay that tax through the entity, and there's a special website that we can let you know about, where you pay those taxes on or before March 15th. And if you pay up to 9.3% of the net income of your business, if it's a pass-through entity, you can claim a credit now on your individual return and get essentially a relief of up to 9.3% of the net income of the business. So it's a huge, huge benefit for S Corp owners, which is brand new this year. But it's important because now we have less than a month to do that calculation and make sure that tax is paid. But be sure to call us if you're in that situation.
So Cliff, I think what I'm hearing is this. Under the Tax Cuts and Jobs Act, the law changed so we can only deduct a maximum of $10,000 of state and local tax on our federal return. With this workaround that has been approved in, maybe approximately half of all different states, essentially, when the dust clears, this workaround essentially all gets back to what the old law was, where you could deduct an unlimited amount of state and local taxes on your federal return.
Up to 9.3% of the net income of the business, which is in many cases a huge difference from prior years. So absolutely something that business owners should take advantage of if you're an Escort or an LLC, but you do need to act quickly because that tax, in order to be deductible on your 2021 return, has to be paid on or before March 15th.
And Cliff, in our waning moments here, is there anything else that you want to tell us before we move on to another subject, partnerships, in our next podcast?
Yeah. So before we talk about partnerships, just with regard to S corporations, absolutely give us a call if you're considering converting from a sole proprietorship or a C Corp to an S Corp. We're happy to offer a free consultation. We can discuss all of these issues, the qualified business income deduction, built-in gains tax, the multi-state tax issues, all things to consider before you make that decision. But in many cases, Steve, we're finding that clients can save a lot of money by making that conversion to an S corporation.
Absolutely. And folks, that's one of the things we would do for you. You come in, we'll chat with you and say, look, if you become an S Corp, here's a list of advantages and here's how much money it would save you, as well as the asset protection, because if somebody sues you, you don't want to lose your personal assets as well. I'd like to thank our guest, Cliff Capdeville. He's the head of our tax department, tax attorney and accountant. Cliff, thanks ever so much.
Thanks, Steve.
You can call us toll free at 1-888-TAX-DEAL. That's 888-TAX-DEAL, 888-TAX-DEAL, or MoskowitzLLP.com, MoskowItzLLP.com. Stay tuned for our next podcast. We're going to talk about partnerships and so many other areas. You look forward to listening to this all the time. Thanks so much. Bye for now, folks.
You've been listening to the Practical Tax Podcast with tax attorney Steve Moskowitz. To hear more podcasts, go to MoskowitZLLP.com/practical tax. The information contained in this podcast is based on information available as obtained at the date of its release. Moskowitz LLP and its affiliates are under no obligation to update this information as changes occur. Applying this information to your specific situation requires careful consideration of all factors which may be applicable, and any information is not to be considered tax advice or legal advice. Further, this is attorney advertising, and the facts and circumstances displayed in this case are dependent entirely on the facts of that particular case. Please consult your tax advisor before acting on any matters discussed.